Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, I'm Vinay Joseph and welcome to another edition of What is Driving the Market, where we look at key market events and address key questions on investors' minds. 2022 has been a challenging year for asset markets, with both bonds and equities giving negative returns. Investing is never easy, especially during these times of uncertainty, as your decision can be easily affected by either hindsight bias or the fear of losses. So how can an investor navigate volatile markets? There is no easy answer, but we think a guideline and checklist could help. And today we enlist 5 key points which can frame as a guideline to navigate volatile markets. First, in uncertain markets, rupee cost averaging strategy, that is spreading out your investments across different periods, can be an effective way to deploy your money, as it helps to mitigate the fear of investing at the wrong time. To quantify the benefits of rupee cost averaging strategies, we compared a simple buy and hold strategy with time-based, quarterly rebalancing, and a drawdown-based strategy, which is when the market corrects 10% over the last 5 years for a balanced 60 equity and 40% bond portfolio. Our study found that drawdown-based strategy, followed by time-based strategy, not only gave higher returns but also saw lower volatility or lower drawdowns as compared to a simple buy and hold strategy. Second, be wary of FOMO. In bullish markets, investors rue missing out a popular trend, creating a sense of FOMO, or fear of missing out, making them chase that trend to possibly disastrous results. The reverse happens in the time of volatile markets, with investors facing a significant FOMO, or cost of missing out, by not being invested given the volatility and uncertainty. A simple analysis of Nifty index over the last 20 years shows that if you stayed invested in equities, you would have made an investment return of 1,080% or an annualized 11.7%. Missing even 10 of the best trading days reduces that returns to 434% or just 7.8% annualized, and if you miss 30 of the best trading days, your returns drop to only 82% or a paltry 2.7% annualized. Further, the best trading days usually coincide or follow the worst trading days, making it impossible to time the market. So having an investment strategy and maintaining the discipline to stick to it could go a long way to prevent one from succumbing to FOMO. The third checklist which you could use is take into account what is the macro environment. As investors, we tend to put a disproportionate focus on the micro environment, overlooking the importance of changing macroeconomic settings. This has a large impact on our investments, as we see that usually the longest equity market drawdowns or index falls of 20% and more usually occur around changes in key macro variables or triggered by changes in the macro environment. The fourth factor is that we should keep our return expectations modest. As we have highlighted time and again this year, Indian markets have shifted to a mid-cycle environment, and history suggests that during this end period, we see volatility higher, plus also equity returns become much more modest during this phase, and they mirror earnings growth. Last and the most important factor, invest in a diversified portfolio. Remaining invested in a diversified portfolio is critical for investors to tide volatile markets. Now, diversification can be done through 3 broad ways. Allocated among different assets like equity, bonds, commodity, cash, real estates, etc., based on one's asset allocation and risk profile. Second, allocating to international markets so that you avoid the single market bias. And last, to spread your investments within an asset class. For example, in equity, have it across different market segment or style, and similarly across bonds, have exposure beyond duration, credit, and interest rate sensitivity. The basic premise of diversification is to have low correlation among the different assets so that the weakness in one particular asset can be offset by another asset. So this is not an exhaustive checklist, but this could be a good starting point for investors to navigate volatile markets. With that, I'll pause for today. And like always, if you like this podcast, please don't forget to like and subscribe. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.